Today, the second part of the Stocks for Beginners video. Stay tuned to learn about the evaluation of a stock price. Folks, fellows and partners in crime, let me welcome you to another Finance Real Talk. Today we will listen again to Uncle Mike with a second part about the Stocks for Beginner course to explain to you how to evaluate properly the stock's value and the stock's price before you're considering any kind of investment. But before we jump in Mike's session, I would like to share with you the following. This channel is called Finance Real Talk, means I'm not like to talk with myself. We need definitely more people, especially from the industry, to have a real talk with those guys. That's why we need more traffic on this channel. And to get more traffic, we need more subscribers and also more likes on each video. You know, those likes are needed to get the right algorithm and also the measurements and to support that video to be more visible on the market or on the playlist. So I need your support to give you the support. So help me to help you. That's why don't forget to hit the like button. And if you like the content, also subscribe to the channel to be updated about the latest trends in financial services and also about the things which are going behind the scenes. You're not really getting those from the mainstream media. So now enjoy Uncle Mike's session and hope you like the content as much as I did.
3, 2, 1.
Hi everybody, this is Uncle Mike with part 2 of Stocks for Beginners. First off the bat, as usual, I'm not a financial advisor nor a financial professional. These are just educational videos on top of other great videos out there. So let's begin and talk about how to evaluate a stock or a company. It's not like we're sitting on a desk and blindly choosing stocks. No, we're actually doing our due diligence and breaking things down and finding out what these stocks are actually worth. So we're going to talk about financial ratios when buying stocks. I'm pretty sure you've heard it all of like what's a PE ratio or a price to sale ratio or things like that. But where do these numbers actually come from? Financial ratios are created with the use of numerical values taken from 3 different financial statements to gain information about a company. So let's talk about number 1. Number 1 is actually the company's balance sheet. It displays the company's total assets and how these assets are financed through either equity or debt. The formula to gaining the total assets are the liabilities plus equity. Number 2 is the income statement, which shows your profit and loss over a period of time. So you typically have your net income. The formula to this is the total revenue plus any gains that you have minus your total expenses plus losses for that. And then there's number 3, a cash flow statement. This is talking about the cash inflow and the cash outflow of a business. So number 1 is operations. These are your business activities. Number 2 is investing. This could be property, plant, and equipment, or capital expenditures. And then there's number 3 is financing. So you have cash flow between your business and your creditors, which is shown on a company sheet. I hope this gives you a better understanding that the price of a stock has nothing to do with the actual value of a stock. In fact, a $20 stock can be overpriced than a $200 stock that is maybe underpriced. It's really only when we research in a company's sales, earnings, assets, or debts that we realize whether a stock is cheap or expensive. So I took these stats from yahoofinance.com and I'm showing you Walmart's valuation measures because they have a longer track history than Tesla, as taken as an example in part 1. That is preferably for growth investors. And as I have told you, the market cap is simply a company's shares outstanding multiplied by the share price, and we see here that Walmart has a market cap of about $400 billion. Next in line is enterprise value, and this is basically the market cap plus total debt minus their cash. EV differs significantly from simple market cap in several ways, and many consider it to be a more accurate representation of a company's value. The value of a company's debt, for example, needs to be paid off by the buyer when taking over a company. As a result, the EV provides a much more accurate takeover valuation because it includes debt in its value calculation. As you can see here, Walmart has a high debt level, which could be alarming for some reasons. But for reference, Google has one of the best balance sheets out there in the world. It's really unbelievable how much cash they have. As of right now, Google's market cap is at $1.5 trillion, and their EV is at $1.4 trillion. That's pretty awesome, right? A PE ratio, or a price to earnings ratio, is calculated by taking the price per share and dividing that by the company's earnings per share, or what we refer to as EPS. This gives us a general idea of how expensive the stock is in relation to their profits, and the lower that number is compared to its competitors, the cheaper or perhaps more undervalued the stock is considered, because you are essentially paying a lower price for the company's earnings or performance versus their competition. Well, unfortunately, there is no PE ratio set in stone that makes a stock a buy if it's below or a sell if it's above. Often, value investors and growth investors will look for different things in a PE ratio. The greater the difference between the stock's intrinsic value and its current price, the more likely a value investor will consider the stock a worthy investment. For value investors, generally speaking, the lower the PE ratio, the better. Growth investors, on the other hand, are actually the opposite. They are much more likely to buy stocks with a higher PE ratio. Believe me, the superior earnings growth more than just justifies the higher cost. Here, the PE ratio is broken down further into what we call the trailing PE ratio and the forward PE ratio. Now we're looking at the trailing PE ratio. That just calculates the ratio using the company's earnings for the past 12 months or the last 4 quarters. So it basically tells us how expensive the stock is in relation to how they performed so far in the past year. Now, the forward PE does the same calculation, except that it uses the earnings expectations for the next year or upcoming 4 quarters based on an analyst's estimates. And so you can see why some investors would prefer to use the trailing PE ratio, because it's actually based on actual performance that has already happened, while other investors might prefer the forward PE ratio because it gives them actually a better idea of where the company is expected to be in the near future. But honestly, both metrics are extremely valuable, so I recommend that you always look at both. Now, in the case of Walmart, they have an okay trailing and forward PE ratio of 29.68 and 24.18 respectively, but how do I know that these stats are actually good? This is where we can start making some comparisons. For example, you can go to multiple.com, multiple without the E, and there you will see the PE ratio for the S&P 500 currently sits pretty higher at 42.10. So this tells us that the value investors would probably be more interested in Walmart stock than a growth investor. But if you would compare this to Tesla, that has a current trailing PE ratio of 1.124, then these stats are what growth investors tend to look for. Moving on to the PEG ratio, or price to earnings to growth ratio. And here, Walmart sits currently shy above 4. Now, the PEG ratio allows you to determine a stock's value like the PE ratio while taking into consideration of the company's earnings growth. It factors the growth as we can see in the stats 5 years out based on an analyst estimate. You can calculate the PEG ratio by taking the PE ratio and dividing it by the projected, as we see here, 5 years, or on actual growth earnings. Generally, a PEG ratio lower than 1 is considered an undervalued stock. For example, by comparing two stocks using the PEG, you can see how much you're paying for growth in each case. A PEG of 1 means you're breaking even if growth continues as it has in the past. A PEG of 2 means you're paying twice as much for projected growth when compared to a stock with a PEG of 1. This is speculative because there is no guarantee that growth will continue as it has in the past. So it seems that Walmart is a bit expensive because the PEG exceeds 1. This gives us a hint that the market expects more growth than estimates predict, or that increased demand for a stock has caused it to be overvalued. Investors are always seeking ways to compare the value of stocks. The price-to-sales ratio utilizes a company's market cap and revenue to determine whether the stock is valued properly. The PS ratio is calculated by taking a company's market cap and dividing it by the company's total sales trailing 12 months. The lower the PS ratio, the more attractive the investment. Price-to-sales provides a useful measure for sizing up stocks. This is one of the easiest ways to understand the valuation of a company, as it helps investors know how much they are truly paying for the company. The PS ratio also helps new companies or startups with zero net income place a valuation on their assets. And as I said, a low PS ratio is considered optimal as it indicates the company is undervalued, but nonetheless, the ratio needs to be looked at from a historical and industry point of view, as well as comparing it with other companies in the same industry. So an investment opportunity should be looked at from all aspects of the company, which can help you identify an underlying issue that cannot be found by looking at the results of each formula individually. Price-to-book ratio is one of the most widely used financial ratios. It compares a company's market price to its book value, essentially showing the value given by the market for each dollar of the company's net worth. High growth companies will often show price-to-book ratios well above 1, whereas companies facing severe distress will occasionally show ratios below 1. So, as you can see here, Walmart is above 1. And how do we calculate the price-to-book ratio? Is just by dividing the market price per share by the book value per share. The book value is the total assets minus total liabilities and dividing it by the company's shares outstanding. The reason why the price-to-book ratio is also an important formula is to help investors understand whether the market price of a company seems reasonable when compared to its balance sheet. For example, if a company shows a high price-to-book value ratio, investors might check to see whether that valuation is justified given other measures, such as its historical return on assets or growth in earnings per share. The PB ratio is also frequently used to screen potential investment opportunities. Of course, there are a ton of other multiples and ratios that you can use to evaluate a company. And that's just for you to decide to give yourself a better understanding if you want to buy the company's share or not. And I want to mention another aspect that many investors like to see is dividends, since that can sometimes influence investors when choosing a stock. As you can see here, Walmart pays a current yield of about 1.56%, which is not that high. But they also have a payout ratio of about 40.46%, a very small 5-year growth rate, but an absolutely massive 47 years of consecutive dividend growth every single year, even throughout recessions or market crashes. Finally, we come to the taxes and fees. So you can buy and sell a stock for a gain, or you can buy and sell a stock for a loss. A capital gain is simply when you sold for greater than you bought it for. Say you bought a stock for $100 and you sold it for about $150. That is called capital gain of $50. Capital loss is simply just the same thing in reverse. You sold it for less than what you bought it for. Means you took a loss. Say for example, you bought a Tesla stock worth of $110 and sold it for $100. That is a capital loss of $10. Short-term capital gain or loss means that you did this within a 1-year time frame. So that Walmart stock you bought and sold within 1 calendar year, this counts as regular taxable income, depending on your income. But that is the percentage you'll pay on that capital gain. Same thing with the long-term capital gain or loss. This is the same thing as the short-term capital gain, except that you held this equity or you made this transaction longer than 1 year. So this being said, with capital gains, this is taxed differently and typically more favorable. And that sums it up for part 2 of Stocks for Beginners. I hope you enjoyed this video, and as always, take care and stay safe.
A big shout out to Mike and all the effort he puts in the preparation for the slides and the session. That's it for today's video. Hope you enjoyed the content. Stay safe and healthy and see you soon.